Let's switch focus though onto another earnings conversation. Kaynes Tech is in focus. The company's profits came in line with estimates while margins expanded. We spoke to the management on their quarter gone by and what aided growth. Listening to that conversation.
On that happy note, see, fundamentally, this year, this quarter, this half, the industrial dominated. But in our business, what happens is that at every stage of business, a different, let's say, we work in 6 different industrial verticals, as we call it. And so a couple of years ago, it was automotive, then it was taken over by EV, now it's industrial. Maybe next year, FY26 will be aerospace, and maybe railways and so on. Okay, so it depends on which kind of say business takes off. Whenever the business takes off, it comes in a large chunk, because some of these businesses are driven by government initiatives, some of them are driven by, of course, large scale investment infrastructure and so on. So as far as the smart meter business is concerned, we've been working on this business for last I think about 3 to 4 years time frame. Iskrameco has been our customer. Now we of course acquired that company. And we think that out of the total 25 crore or 250 million smart meters that have to be installed, about 10 million have been done already. And Iskrameco has also contributed about 10-15% of that particular number. So they also have a fairly good experience in the marketplace. And to some extent, we can say that the smart meter installation has become, let's say, standard. It's kind of stabilized. So there are no more surprises in terms of how to run it and how the SLAs are being maintained, etc. Having said this, about half of those meters have been awarded, and we are expecting about 15 to 20% share of that market. So of the total market, let's say about 15% share of a 25 crore market would mean that this business will be a large number. So we think that over next, let's say 5 to 10 years time frame, we would have revenues anywhere between 500 to 1,000 crores per annum just on account of smart meters alone. And so this is assuming that we have about 15% kind of market share. We have superimposed also going forward. We have been approved by one of the largest European power sector players, and we probably should start off our exports too sometime in FY26 time frame. So I think this is this power electronics business, which is led by the smart meters, would probably continue for at least a decade or so. And so we think that it will also be a good portion of our business. And these are, at this point in time, there's a demand supply gap. So they are also margin accretive compared to our total overall portfolio.
So Sampath, the auto segment has also seen a strong growth of 28% YOY. What are you expecting from this segment? And given the current industry environment, are there new client acquisition, product launches anticipated? And between industrials and the auto segment, what is the compounded growth rate you're targeting over the next few years?
Yeah, so one broad comment is that between industrial, EV and auto put together, this will grow at minimum 50 to 60% compounded year on year for next at least whatever foreseeable years that we can see, maybe 5 to 10 years time frame. Now, as far as automotive is concerned, what we are now focusing on is to improve the quality of our portfolio. So we've got some new major, let's say, tier 1 players who are Europe's largest player also on board. And we are trying to make sure that our strategy of specializing in certain product categories and working with really good, say, clients works on. So we expect the automotive segment to grow at the same rate as company growth, so like 50% plus kind of growth. As far as industrial and EV is concerned, in electric vehicles, obviously there is four-wheeler is still in the, let's say, it's not a stable phase right now. Newer product launches are expected. We think that before it becomes standard purchase product in India, I think we will probably have some more time, maybe 6 months to a year time when all these launches come up, etc. In the meanwhile, two-wheeler and also infrastructural things like chargers, etc. And also there are some exports that we've been successfully able to get approval from. So these are global exports of components in the EV space, and these are components common with the automotive space. As far as industrials is concerned, we have smart meters, of course, a large chunky business, everybody sees it, so I don't need to elaborate on that. But then there are other sectors like power electronics, wherein we are one of the largest players in India, and that is likely to grow very well because they're shifting some business from China. Then obviously there is one more instrumentation business. We have acquired some company in the US. So because of that acquisition, this is a US-based company, so they are saying that now we can work with you better because then you can keep local stocks and services. So all of these put together, industrial, EV, and automotive, it will give a tough competition to the remaining sectors in terms of growth. But we also have, on the other hand, railway signaling, which is kind of still not come back to its former glory because there was elections, and then there is, of course, some delay in government budgets being implemented. But I think that is, I think, sorted now. We started getting some schedules. So railway signaling is something which is going to take off in the second half, as well as aerospace is concerned, which will take off in FY26. So going forward, I think we will have a fairly good, let's say, competition, quote unquote, among these sectors in our portfolio.
So growth of 30 to 40% is possible. Why? Because if you're going to start firing from every cylinder, then what is stopping you, right? Is that a fair expectation?
Yeah, it should. See, at this point in time, this is early stages, right? It's the early stages of growth. So I wouldn't be surprised if the growth is 50%.
Oh, wow. Okay, so that is the sort of growth we are expecting. Yes. The other thing, Mr. Sampath, that is a standout, and here you are outdoing your industry. So that is, of course, very commendable, right? Your margins have come in at 14.4%, which is above most brokerage forecast. Can you tell me what has driven margins, and are margins sustainable at these levels? I do know that you've guided for closer to 15, but is there any upside risk we carry on this? And also raw material costs have declined. So that downward trajectory continues, then 16, 17% likely in the second half of the year?
Yeah, no, your analysis is quite insightful. There are only two ways in which people improve their margins. One is by leveraging. That means the same amount of cost you do more sales, right? So if you double your sales with the same base of cost, you don't hire too many people, etc. Only the variable costs change with some operators and so on, factory costs, etc. Then there is a operating leverage you get. The second one is, of course, gross margin. You correctly caught it. So in the first half, we have had an increase in gross margin because of industrial segment, and second half we'll have increase in further gross margins because of railway and aerospace taking off, and also some IT work we will do. So these two put together, yeah, there is a possibility of upside beyond 15% in as far as margins is concerned this year itself. And going forward on a consolidated basis, of course, this year, please mind you, we are taking some extra costs on account of new projects like semicon assembly and PC board, because the teams have been hired and we are kind of having employee expenses and a lot of other things that are coming in the consolidation. So I think, yeah, FY25, we will definitely get beyond 15%. How much more will depends on how well we do in the second half and how much we are able to pull up the revenue beyond 3,000 crores. And it's certainly FY26 is going to be probably better than FY25. In that, we will have the newer businesses like semicon assembly as well as PC board assembly also doing their bit to add to the consolidated profits. So yeah, FY26 is going to be also slightly better than FY25.
Wow, clearly the road ahead looks so much better than the road behind. I cannot not ask you about OSAT because there's so much riding on this, right? I do understand revenue can be expected from the fourth quarter of 26, so we're still 1 year out in that sense. But when that picks up, there are some beliefs, some reports that indicate that your margins could get lifted all the way to 24, 25. Is that a realistic expectation? And if yes, give me a sense of timelines.
Sure. I think the question is also very correctly put. So FY26, you can expect our legacy packaging business, with our total capex of about 3,300 crores, will be kind of implemented 25% in the legacy packaging, which is typically lower margin profile. It has about 17, 18, 19% margin kind of number. And then 75% of it, which comes later on after FY26 implementation, that would be definitely 25% plus kind of margins in the advanced packaging area. So blended margin as we go forward, yeah, FY26 may not diminish our margins, but it may not be that much margin accretive in FY26 because we'd also have lower capacity utilization. We might have just 40% utilization in the fourth quarter of FY26. But going forward, let's say FY30, let's fast forward to FY30. FY30, I won't be surprised if our, let's say, blended margins on a standalone basis in the OSAT business will be excess of, say, 25%, around 25%. And that is when we think that the business is sustainable, because we think that at this point in time, of course, we do ride the what we call the capital subsidy given by central government and state government. So numbers look good, and we look fairly decent in terms of profitability and ROC. But then the moment we exhaust this subsidy, that means further next level of investment if we have to do, then the business should make sense on its own. And given that these are capital intensive businesses with asset turnover of about asset to sales ratio about 1 to 1.5, we think that it will make sense only if the late 20s kind of margins are there. Then we'll probably be able to invest and grow this business further without, of course, infusion of funds from outside. So this is the thinking. So we always think about, yeah, we do take advantage of subsidies and incentives and so on, but we always think about future life without help of these subsidies, because these subsidies can be accessed by all players, right? Whether it's Taiwanese player, Japanese player, Korean player, and the way it is going, maybe even Chinese players can probably come to India and do whatever the government is bidding them to do. Of course, the government will be mindful of the fact that we don't want to hand over the entire strategic portfolio on a platter. But on the other hand, I think let's assume that all the global players will have all the advantages that Indian players have from the government today. So that's why we were working very hard to make sure that the portfolio works for itself and makes it a sustaining and self-sustaining business. So this is the part of activity which everybody, other players also do, then they can also enjoy the benefit of a sustainably profitable business.